Knowing a business's worth is fundamental. It's crucial for buying or selling a business. It impacts investment decisions. It's also key for tax purposes and even during litigation. Without accurate valuation, you're navigating the business world in the dark. Think of buying a house. You wouldn't pay any price the seller asks. You'd research similar homes. You'd consider the house's condition. You'd factor in location. Business valuation is similar. It's about determining a fair and realistic price tag for a company, considering various factors. This essay will demystify business valuation. We'll explore different methods, making complex concepts clear and concise. Understanding these methods empowers you to make informed decisions, whether you're an entrepreneur, investor, or simply curious about the business world. Let's dive in. The income approach focuses on a simple idea. A business is worth the money it can generate in the future. This approach analyzes a company's earnings and converts them into an estimate of its present value. Essentially, it's like looking at a company's earning potential and discounting it to today's value. Imagine a company that makes high-quality, in-demand widgets. They have a solid track record of profitability. They're poised for future growth. The income approach would consider these factors. It would project the company's future earnings based on this information. This method is particularly useful for businesses with predictable revenue streams, like subscription services or established manufacturing companies. By understanding the income approach, you gain insight into how future earnings translate into present-day value. The discounted cash flow, DCF, method is a popular income approach technique. It involves forecasting a company's future cash flows. These cash flows are then discounted back to their present value. This discounting reflects the time value of money. Think of it this way. $1 today is worth more than $1 tomorrow. Why? Because you can invest today's dollar and earn a return. The DCF model accounts for this by discounting future cash flows. The discount rate reflects the risk associated with investment. For example, a risky startup will have a higher discount rate than a well-established blue chip company. DCF is a powerful tool. However, it requires careful consideration of various factors. These include future cash flow projections and the appropriate discount rate. The market approach determines a business's worth by comparing it to similar companies that have been recently sold or are publicly traded. It's like evaluating a house based on the prices of comparable homes in the neighborhood. This approach relies on finding publicly available data for comparable companies. This data includes their financials, market capitalization, and recent transaction prices. By analyzing these metrics, analysts can establish a benchmark for valuing the target business. The market approach is most effective when there's ample data on comparable companies. It's particularly useful for valuing businesses in mature industries with many publicly traded competitors. Comparable company analysis. Finding the right comparisons. Comparable company analysis, or CCA, is a key tool within the market approach. It involves identifying companies with similar business models, industries, size, and growth prospects. Analysts then compare the target company's financials and market valuation to these comparables. For instance, imagine valuing a regional coffee chain. You might compare it to other publicly traded coffee chains. You'd analyze their price-to-earnings ratios, revenue multiples, and other relevant metrics. This comparison provides a basis for estimating the target company's value. Finding the right comparables is crucial for accurate valuation. Analysts must consider various factors, including market dynamics, competitive landscape, and company-specific characteristics. Exploring the asset-based approach. What's in the balance sheet? The asset-based approach determines a company's worth based on its net asset value. This approach focuses on the company's balance sheet. It calculates the difference between its assets and liabilities. Imagine valuing a manufacturing company with significant tangible assets. These assets might include factories, equipment, and inventory. The asset-based approach would consider the market value of these assets. It would also factor in liabilities like debt and accounts payable. This approach is often used for valuing capital-intensive businesses or companies facing liquidation. It provides a straightforward way to assess a company's net worth based on its underlying assets. Real-world applications. Putting valuation methods into practice. Let's look at real-world examples. Imagine a tech startup seeking funding. They might use the income approach, specifically DCF, to project their future earnings and attract investment. A private equity firm looking to acquire a manufacturing company might use the market approach. They'd compare the target company to publicly traded competitors to determine a fair acquisition price. Finally, a lender assessing the collateral for a loan might use the asset-based approach. They'd focus on the borrower's tangible assets to determine the loan's security. These examples illustrate how different valuation methods are applied in various business scenarios. Choosing the right valuation method. A contextual decision. No single valuation method fits all situations. The best approach depends on the specific circumstances. These include the purpose of the valuation, the industry, the company's stage of development, and data availability. For example, the income approach, like DCF, is suitable for companies with predictable cash flows. The market approach, like CCA, is effective when there's ample data on comparable companies. The asset-based approach is often used for capital-intensive businesses or in liquidation scenarios. Experienced analysts often use a combination of methods. They then reconcile the results to arrive at a well-rounded valuation. Understanding the strengths and limitations of each method is crucial for making informed decisions. The enduring value of accurate business valuation. Accurate business valuation is paramount in the business world. It informs critical decisions, from buying and selling companies to securing funding and making strategic investments. By understanding the different valuation methods, we can navigate the complexities of assessing a business's true worth. The income approach, particularly DCF, focuses on future earnings potential. The market approach, including CCA, relies on comparisons with similar companies. The asset-based approach emphasizes a company's net asset value. By grasping these methods and their nuances, we equip ourselves with the knowledge to make informed decisions in the ever-evolving world of business. Are you ready to unlock the full potential of your business and captivate prospective buyers? Imagine having a clear, compelling analysis of what your business looks like to a discerning purchaser, highlighting its strengths, addressing its challenges, and showcasing its future growth. This isn't just about numbers. It's about telling the story of your hard work and dedication in a way that resonates with buyers. Don't leave this critical step to chance. Schedule an initial consultation at www.jamesmontgomerylaw.com and discover how a comprehensive business analysis can transform your selling journey. Let's take this pivotal step together and make your business sale as rewarding as your entrepreneurial journey.